Welcome to the June 4th, 2018 Advance Report for McGowanGroup Asset Management clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with a fast-paced tour of the global markets and the trading week with key educational points and portfolio strategy implications. Here we go. Russell 2000 Small Stock Index, a new high with distance. Wow, look at that, 16,050 at the high this week. Notice the rebalancing correction, the winter storm at the end of January, and a steady recovery. U.S. small stocks on fire, all-time highs. Let's check on the Dow. Dow Jones Industrial Average hit 26.5. Traded down to about 23,000 in the rebalancing correction at the end of January, early February. We've been range bound ever since, as we predicted, and we're still range bound. 24,500 was about the sine wave this week. This is Italy right here, and that's an Italian rebound. The fears of an Italian collapse, way overblown. It happens once a year. About once a year, their government collapses, and then they assume that Italy's going to leave the European Union, and then we'll all die in pandemonium and chaos. But here's the real story. Let's actually look at some numbers here. The 10-year Italian Treasury, 2.8%. Well, Italy's borrowing money at less than the U.S. Treasury. That doesn't make any sense. Look, the United States actually 2.83, and that's after the supposed Italian crisis. You could see the rebound in the Dow that we just covered. Notice Argentina pays 7.5%, Brazil pays 5.5%. In Switzerland, you have to pay them to get them to take your money. And Greece, they're always the poster child of crisis, 4.5%. So, is there an Italian crisis? Not based on this at all. Here we go. This is the U.S. Treasury. What you've got here is the 2.99%, essentially 3% on the 30-year Treasury. This is the price up here, 121.74. That's a large premium, by the way, on the 20-year U.S. Treasury Index. Price and yield are exact inverse. It's just a mathematical calculation that bond traders do all the time. And so you look at this, you could see the crisis, and you could see the price of the Treasury skyrocketing because everybody was scared back in the crisis. And notice what's happened since. You have relative stability in the price of that 20-year Treasury, and that's in the face of the short rates coming up. We've been pointing this out. But there's not much lower you can go. In other words, there's not much price appreciation left if something's trading at 121% of par. Quite a bit of duration risk in exchange for 3%. It just doesn't make sense. What does make sense? Well, let's put our inflation hedge on before inflation comes. What you're seeing right here, we've covered this before, but it's important to update. Thanks to our own Stephen Norris, Super Chuck, we've nicknamed him. We have the percentage change in oil, the burnt orange graph, appropriately enough, and the percentage change in the pipelines. That's the colorful graph. Notice pipelines caught up to oil in the percentage decline after oil topped $100 and the pipelines were the rage. Everybody was recommending them. We got stopped out of these thanks to Alex, and we've wanted to get back in since right here. Well, we've waited 3 years to do this, and the finances of the pipeline companies across the board are improving. Lots of cash flow, Permian Basin flow, liquid natural gas. We're going to cover more details in the program, so be sure to go to NetWorthRadio.com where we go in-depth discussion of the fabulous liquid natural gas market globally and what that means for investors. The pipelines are paying incredible yields above 8% in many cases, and what you see here is oil has had just a pretty steady climb, and the pipeline index had two capitulation sell-offs. This last one was at the end of the first quarter. Now we notice the rebound in process here. What's the differential? Well, if pipelines catch up to oil, the potential capital gain is over 120%. It's not a guarantee, but it is a differential that could be, one, a source of income in the pipelines, and two, a source of appreciation over the next 5 to 10 years. Yes, a potential double based upon 2014 pricing. I'm Spencer McGowan, your financial weatherman, president, McGowan Group. Join us at NetWorthRadio.com. We'll be back next week for your fast-paced tour of the global markets. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at NetWorthRadio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations in bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.